Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Uranium Energy Corp.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Absolutely. And before we really jump into today's deep dive, just a quick reminder about StockOracle.
Right, yes. We have a 14-day trial link for StockOracle down in the description.
And full disclosure, it is an affiliate link, so we do get a small commission if you sign up using that.
Yeah, but please remember, any AI insights or, value estimates you see on there, or really anything we discussed today, they can be wrong. You always need to verify the data yourself.
Exactly. Nothing we talk about is financial advice.
Yeah.
We're not telling you to buy, sell, or hold anything.
No, we are purely looking at this from a long-term wealth-building perspective, focusing on durable growth, protecting capital, and real fundamentals.
Which makes today's topic so interesting.
It really does. So let's get into Uranium Energy Corp, or UEC, as of August 22nd, 2026. And honestly, this stock is a massive contradiction.
Oh, it's a complete paradox.
Right. Like, usually when we pull a multi-billion-dollar valuation into focus on this show, there's a baseline assumption of financial gravity.
Yeah, you expect humming production lines, or at least, expanding market share.
Exactly. At the absolute minimum, you want top-line revenue hitting the income statement. You want to see the business compounding shareholder value.
The basic physics of equity markets, right? You build a mousetrap, you sell it, and the market slaps a multiple on your trailing cash flows.
But you step into the current landscape of the energy transition, and those physics they completely break down.
Oh, boy.
Like, let's look at the scale of this paradox. We are staring at a massive $4.8 billion market cap. And just yesterday, August 21st, the stock printed a violent 14.4% surge in a single trading session.
Closing at $12.76, yeah.
Right. And you look at that price action and you assume, as an investor, that the underlying business quality is pristine, that the existing engine is just firing on all cylinders.
No, it's not.
No. You pull up their most recently reported quarter from February to April 2026, and the revenue line is exactly zero.
$0. Not a rounding error.
Literally zero. So, okay, let's unpack this. How does an asset with collapsing, zeroed-out revenues command a nearly $5 billion premium?
Well, to bridge that gap, you basically have to entirely detach from their current income statement.
Which is terrifying for a cautious investor.
I know it is.
Yeah.
But the market is bidding up UEC based on optionality. Investors are essentially paying a massive premium for, a call option on a future where two huge macroeconomic tectonic plates collide.
Okay, so long-term industry tailwinds.
Exactly. And if we connect this to the bigger picture, the first of those plates is aggressive government intervention. Specifically, the U.S. Section 232 trade policy.
Right, the push for domestic supply security. And just to be clear for the listener, we aren't taking any political sides here. We're just reporting on the reality of the policy from our sources.
Absolutely.
Yeah.
The mechanics of Section 232 basically dictate a structural pivot away from foreign reliance for critical materials.
And for uranium, that's the baseload fuel for the whole nation's nuclear reactor fleet.
Right. The policy essentially forces domestic utility companies to re-architect their supply chains, right? They have to source a mandated percentage of their fuel from within the United States.
Which creates a massive artificial moat.
It's the entire foundation of the bull thesis. Historically, domestic utilities were, perfectly happy buying cheaper uranium from foreign state-owned enterprises.
Because it was a globalized commodity market.
Exactly. But Section 232 shatters that dynamic. It prioritizes national security over raw cost efficiency.
Yeah.
So it artificially constrains supply and establishes a localized demand floor.
So for a U.S.-focused developer like UEC, the government is effectively stepping in and manufacturing a captive market.
Yes, they're sitting directly downstream of a federal mandate.
Which theoretically insulates them from the absolute worst of global spot price volatility because, domestic utilities will have to buy American yellowcake even if foreign supply is cheaper.
Right. But a policy tailwind alone doesn't usually trigger a 14% one-day pop.
No, it doesn't.
There is a second engine here, and it's driving this broader energy supercycle. And that is artificial intelligence.
Yeah, the ultimate demand shock.
It really is. It's completely rewiring how analysts are forecasting baseload power requirements for, the next decade.
I mean, we're seeing these hyperscalers building out AI training clusters that require gigawatts of power.
Oh,
A single massive data center now draws the equivalent energy of a medium-sized city.
that's unbelievable.
And because these tech giants have strict, net zero carbon commitments, they can't bridge that power deficit with natural gas or coal.
Nope. And intermittent renewables like solar and wind, they just can't physically provide the 24/7 uptime required for AI workloads.
So the only carbon-free baseload power source capable of meeting that density is nuclear.
Which turns UEC into this really fascinating proxy trade. The market sees tech giants implicitly demanding a massive expansion of nuclear capacity.
Right, reactor restarts or those new small modular reactors.
Exactly. And all of that infrastructure requires raw fuel. So buying a domestic uranium developer has become a backdoor play on the AI infrastructure boom.
You're bypassing the semiconductor and software multiples entirely.
Exactly.
Okay, I understand the gravity of that narrative, the compounding effect of federal protectionism and hyperscaler demand. It's a great story. But this is where I have to step in and look at the actual business fundamentals.
I knew you would.
I have to. A narrative doesn't pay operating expenses. Does any of this actually translate to the bottom line right now? Because we focus on real wealth building, not just chasing sentiment.
Well, the current financial reality is brutal. I'll admit that. The macro narrative has not translated into operational cash flow at all.
No, it hasn't. If you isolate the fundamentals, the business is deteriorating rapidly. Let's look at the existing engine.
Go for it.
Over the 10-month period ending April 30th, 2026, UEC's revenue collapsed by nearly 70%. They landed at just $20.2 million.
Yeah, and compare that to the nearly $67 million they generated in the same period a year prior.
It's a cliff. And like we said, the most recent quarter flatlined at 0. But the operational burn rate didn't pause, did it?
No, it actually accelerated.
Yeah.
Over that same 10-month period, net losses widened to $76.6 million.
And the trailing 12-month net margin sits at negative 69%. I mean, we are watching operating leverage work in reverse here.
Well, they have significant fixed costs, right, required to maintain their assets and push these projects through the regulatory pipeline.
Right. And when revenue evaporates, those fixed costs immediately chew through whatever bottom line is left. So we have a trailing price-to-sales ratio sitting at 273.65.
273, it's massive.
It's astronomical. With a multiple like that, the market has completely decoupled from trailing fundamentals. This isn't a traditional valuation based on cash flow. It's being priced like a phase 3 biotech company.
Oh, that's a perfect comparison.
Right. You aren't buying the stock for the pills they sold last quarter. You're paying a massive premium because you believe the FDA is going to approve a blockbuster drug tomorrow.
Yeah, you're buying the binary outcome of their asset pipeline. But waiting for that approval, or in UEC's case, waiting for a mine to reach commercial production, it requires massive amounts of capital.
Huge amounts. Which brings us to the actual math of their survival. They are burning roughly $9 million a month in operating cash right now.
Yeah.
Now, if they were carrying a heavy debt load in this high interest rate environment, a 273 PS ratio would just be a death sentence.
It will be game over.
But looking at the balance sheet in our research, this is their saving grace. They are sitting on a $488 million fortress of cash and cash equivalents.
With virtually zero long-term debt.
Exactly. Zero long-term debt. So my math says they have a solid 4 to 5 year runway before they even need to think about tapping the equity or debt markets for emergency liquidity.
And that balance sheet is honestly the only reason the market is allowing them to maintain this valuation. It's the structural bridge to their future.
It buys them half a decade to execute.
Exactly. But you're right, they can't just harvest interest on a cash pile indefinitely. So how do they actually flip the switch and capture this demand?
Right. Let's talk about the catalyst roadmap. What is the emerging engine that's going to actually generate cash?
Well, the research outlines a blueprint that relies on transitioning from just holding resources to being an active producer. And that starts with their near to medium-term catalyst, the Horseshoe Raven project.
Okay, advancing Horseshoe Raven toward commercial production.
Right. Right now, they're sitting on proven deposits in the ground. The market is pricing in the successful extraction of those reserves.
Right, converting in-situ resources into above-ground inventory that they can actually sell into long-term utility contracts.
Exactly. That's step one to fixing the income statement.
But mining is inherently cyclical. It's entirely leveraged to the commodity spot price, which is risky.
It is, but here is where their optionality really shines. This is their long-term growth driver.
Yeah.
UEC isn't just trying to extract yellow cake and throw it on the open market.
They want to process it.
Yes. The second major piece of their strategy is vertical integration, specifically centered on their URNC domestic conversion facility.
Which received those NRC, the Nuclear Regulatory Commission, licensing updates back in March 2026.
Exactly. And what's fascinating here is the underlying mechanism of the nuclear fuel cycle. You see, when you mine uranium, you get U3O8, which is yellow cake.
Right.
But you cannot just put yellow cake into a commercial reactor.
No, it has to be converted.
Right. It goes through this highly toxic, specialized chemical process to be converted into uranium hexafluoride, or UF6. Only then can it be enriched and made into fuel rods.
And global conversion capacity, it's a huge choke point.
Massive bottleneck. There are very few facilities in the world capable of handling that process. And historically, a lot of that capacity sat in places like Russia.
So by pushing the URNC facility through the NRC, UEC is trying to capture this high-margin choke point in the domestic supply chain.
It entirely changes their economic profile.
Because if you only mine yellow cake, you're just a price taker. Your margins live and die by daily commodity swings.
Exactly. But by vertically integrating into conversion, UEC can capture the conversion spread. That's the premium utilities pay to turn raw material into usable gas.
So it allows them to negotiate decoupled long-term tolling agreements.
Yes, providing a much more stable, predictable revenue stream that isn't completely reliant on just mining economics.
They become a midstream toll collector, not just an upstream miner. So that's the real thesis here. The market is preemptively pricing in a future where Horseshoe Raven is producing, the URNC facility is converting, all exactly when the Section 232 mandates kick in and AI data centers drain the grid.
It's a brilliant blueprint, but execution is everything.
Always is. And execution takes time. So let's do a technical and sentiment check on where we are right now.
Yeah, because when a valuation is built entirely on forward-looking optionality, the stock becomes hypersensitive to sentiment changes.
Extremely. Like
Yeah.
that violent 14% surge on August 21st, it looks like a fundamental breakout, but the technical data suggests it's purely momentum driven.
Right. The RSI, the Relative Strength Index, spiked to 79.12 on that move.
And anything over 70 flash is technically overbought, meaning the velocity of the buying frenzy has mathematically outpaced any fundamental justification.
It's a textbook sentiment squeeze. The capital flowing in that day wasn't, institutional money making a calculated bet on the URNC facility's 2028 cash flows.
No, it was hot money chasing a breakout.
We know this because of the stark divergence from the broader sector. Just 24 hours prior, on August 20th, the wider nuclear space had a notable sell-off.
Right, peers like NewScale and Oklo took significant hits.
Yeah. UEC is whipsawing entirely on narrative flow rather than structural news right now.
And when a stock trades at a 273 multiple and flash is overbought, investors start scrutinizing the filings, looking for any cracks.
Oh, definitely.
Which brings us to the insider selling. We saw a filing for a 55,000 share dump by an executive on August 11th.
Right, and this raises such an important point about market literacy. A headline flashes. Insider offloads 55,000 shares right after a massive revenue collapse.
And retail investors panic. They think management is abandoning ship.
Exactly. But when we parse the actual Form 4 filing from our research, the mechanics tell a totally different story.
It wasn't a discretionary market order, was it?
No, it was an automatic tax withholding transaction tied to the vesting of restricted stock units, or RSUs.
Right. When an executive's RSUs vest, they're hit with an immediate tax liability for the value of those shares.
Right. And to cover that liability without making the executive wire a bunch of cash to the IRS, the company automatically liquidates a portion of the newly vested shares.
So they didn't log into their brokerage and hit sell. It was just mechanical liquidation for taxes.
Exactly. And if you track the remaining holdings post-transaction, that same insider is still sitting on 1.2 million shares.
Valued at roughly $11.9 million.
Their equity alignment with the long-term thesis remains completely intact.
So that's a non-event. But looking at what could go wrong, there is a structural vulnerability here that we absolutely have to talk about. The ultimate threat to this wealth-building thesis.
Yes. The single variable that could collapse that premium overnight is the underlying volatility of the uranium spot price.
Right. We talked about how Section 232 and AI create this theoretical demand floor. but commodity markets are ruthless.
They really are. They often defy long-term logic in the short term.
If global supply chains shift, or, if the rollout of these AI data centers faces regulatory friction that slows down power demand, the spot price of uranium could easily gap down.
And if that spot price drops below UEC's projected all-in sustaining costs, the entire blueprint shatters.
Because projects like Horseshoe Raven have a hard economic threshold.
Exactly. If it costs them $50 to pull a pound of uranium out of the ground, and the spot price drops to $40, that mine stays closed.
The resources remain stranded. And if the mine doesn't open, the URNT conversion facility has no internal feedstock to process.
So the vertical integration strategy stalls.
And suddenly, that $488 million cash pile isn't a strategic war chest anymore. It just becomes a slowly depreciating survival fund.
Paying corporate overhead while they wait for the cycle to turn, the clock on that 5-year runway suddenly feels a lot faster.
Right. So the leverage cuts both ways. The market is pricing in the absolute best-case scenario. If macro conditions force a delay, the multiple compression from a PS of 273 will be brutal.
It would be ugly.
So let's synthesize this. Let's look at the 3 to 5 year blue sky scenario, and then the base case. And again, the blue sky is an optimistic outline, not a prediction.
Right. So the blue sky case, projecting out 3 to 5 years, if Section 232 mandates fully insulate domestic pricing, and if Horseshoe Raven scales to commercial production without massive capital overruns.
And if the URNC conversion facility clears the NRC and captures that midstream margin spread.
And they graduate. They go from a speculative developer to a vertically integrated, high-margin cornerstone of the domestic nuclear supply chain.
Right. They would capture economics at multiple stages of the fuel cycle, feeding directly into the largest infrastructure build-out in modern history. That's the strongest long-term driver.
Absolutely. But the neutral base case, rooted strictly in the data as of August 2026, views UEC as a highly speculative binary option.
Right. They possess a pristine balance sheet that guarantees near-term survival, but they are a zero-revenue entity trading at an astronomical premium.
The market is absorbing immense execution risk, banking entirely on a future that is still conceptual.
Exactly. So from an overall investment rating standpoint, strictly based on the fundamentals we've covered, it rates as a highly speculative optionality play. Not a reliable wealth compounder today, but a high-risk bet on a macroeconomic shift.
Perfectly said. You have to balance the sheer scale of the AI and energy transition narrative against the cold, hard reality of negative operating leverage.
You can fully believe in the necessity of nuclear baseload power without assuming every domestic developer is going to execute flawlessly.
It demands immense discipline. The market is offering a premium for strategic positioning, but positioning is not production.
No, it's not.
Which actually leaves me with a broader, somewhat unsettling thought for you to mull over.
Oh. Where does the logic break down?
Well, we just spent all this time dissecting a $4.8 billion company with zero revenue. If the AI revolution and national security mandates are accelerating to the point where geographic location and federal policy alignment carry more weight than trailing cash flows, are we entering a new paradigm?
Wow.
Right? If governments and hyperscalers are essentially anointing the winners of the energy transition before a single ounce of fuel is even commercialized, is traditional fundamentals-based financial analysis fundamentally broken?
That is a fascinating question. I'll definitely be reevaluating my discounted cash flow models tonight on that note.
Good luck with that.
Thanks. And just a final reminder before we go, be sure to check out the StockOracle 14-day trial link in the description. Again, affiliate link, but a great tool for tracking these wild macro trends.
But always verify the AI insights yourself.
Always. See you next time on Smart Wealth.